Welcome everyone. Today I'm going to discuss about startup and investment. If you focus on today's presentation, we can find starting with a plan, financing startup, financial growth, valuing the business, risk point and associates funding, development risk, fast customer, manufacturing risk, marketing risk, management risk, initial public offering, preparing for the startup seed capital friends and family private investors, SBIR or STTR. Early stage funding, private investors, some venture capital strategic partners, less stage funding, venture capital, public equity strategic partner. The fundamental truth about raising money: take twice as long as projected. Investor identified many not work out. Second round may request buyout. Significant cost to raising capital. Cost of raising capital: upfront cost, financial consultant, CPA, auditor, banker. Marketing cost, prospectus, legal, printed. Back end cost, bank, legal, brokerage, easily up to $200,000. Can you impress investor? Defensible competitive advantage. Patent technology, cycle time, marketing, advertisement, sales force, low cost manufacturing, customer experience, crowd marketing, who are your friends. The first stage, personal resources, angel, small business investment companies. Second stage, public equity stage, sponsor venture capital companies, venture capital, strategic alliance, SBIC. Third stage, public equity venture capital companies. Start with a financial strategy. Look for smart money who invest in more important than terms. Buy top management with fast dollar. Get more fast early prototype with customer feedback. Focus on one investors and get an intro. Do not marry your first date. Go for the best deal, not the biggest. Financing the startup: entrepreneur resources, saving, credit card, mortgage, stock market account, friendly and family. Bootcamps: hire a few companies as possible, laser or share environment, use other people money. Boostering in an incubator: average incube sales increase 400 times from time enter into the time. Average annual growth is sales was 239,535. 87% of the grant still in business, only 20% of new startup. Do incubator meet needs? Higher order need to be met. Human network, access to expertise, capital, partnership, professional resources, product design, first 100 customer. Some negatives: perceptions of being a babies, artificial buyers, equity stake by incubators. Educate white males 40 to or 50, net worth over 750k dollar, used to be entrepreneur, fast estate financing and young farms. Invest near homes, involve only 2 deals a year, invest between 100,000 to 500,000 dollar. More an angel, 3 to 10 years time frame for return on investment, 5 to 10 times their investment, function of risk. Find deals through referrals from business associate, make decision more quickly. Requirement for dual diligence may be lower. Order of investment interest: manufacturing, industrial or commercial, manufacturing, consumer, energy or natural resources, service, retail or wholesale. An unlikely angel investment: a Me Too type of product, no intellectual property, business location more than 100 miles away, mature or fading industries, return of investment less than 15%, not enough market research with customer, weak competitive analysis. A poorly defined vision for the company, no management team or solo entrepreneurs, weak management team with no experience, exist time more than 7 years ago, unfamiliar business or industry, minority position with no voting rights, too many co-investors. What winning angel do? Consider the resources carefully, focus on the model, not the plan. Emphasize the entrepreneur and the team, seek a scalable business, look for the exist, identify the unfair advantage, focus on deal where they know something. Stage 1 or 2, private placement, raising capital from private investors, securities, common or preferred stocks, notes, bonds, debentures, limited partnership share, etc. REGD, sophisticated investor, blue sky loss. Advantage: less costly, less time consuming than IPO, availability of standardized offering statement, do not have to file with SEC. Strategic and alliance R&D limited partnerships, joint venture. Small business investment company SMI SBIR grants. Phase 1, develop concept and test feasibility, purchase the innovation and deep the product, commercialize the technology. Debt source, commercial bank, commercial financial company, small business administrator, state fund, venture capital, incubator, customer and suppliers. Venture capital, less than 1% of 300K companies grow 20% plus per year, backed by VC. Investment deal has amount of money to be invested, timing and use of investment money, return on investment to investors, level of risk involved, preferred stock to debentures. Rule for dealing with VC: know your enemy, do not shop the business plan, approach through a referral, write a killer executive summary, check out the term sheet carefully, be patient, be prepared for a stage investment. Local VC related to local can matters, growth track, bigger is better. 10x investment in 5 years, 25 to 50%, PE 15 to 1%. Plan exit. Make it short, new paradigm, lead products, number of co-investors, bridge financing to top position for an IPO, board set. Ownership stage, give up 30% of every 1 million, 2 to 3 give 8 to 15%, 1 million dollar give up to 5 to 6%. Identify your dream, do not accept term sheet before due diligence. Request 5 reference from each VC. Interview reference. Why did you choose this firm? How effective have they been in searching deals and partnership? How effective have they been in recruiting board members? How have them helped your company increase its valuation? On a scale 1 to 5, how would you rate the contract partner? IPO process: choose an investor bank, draw up a letter or intent, terms and conditions, file a registration statement with the SEC, public the tombstones, direct on a stock exchange, go on a roadshow prior to IPO. Advantage of going public: source of interest, free growth capital, more prestige and clout, easiest to form alliance and negotiate share deals, public stock used to attract employees and reward existing employees. Existing process $300,000, time consuming, company information in public, ACO responsible to shareholder, entrepreneur may not control stocks, pressure to perform in the term SEC report requirement. Of 3,186 firms that went public in 1980, only 58% is still listed on of the three major exchanges. The stock on only three of these firms was selling above issue price. Major financial instrument at different milestones. First, customer research and developments, break events, multiple customer, profitable need explain capital, multiple product, payout, merger and IPO. Valuation of the business, fair market value, willing seller and buyer, intrinsic value, interest, balance sheet and income statement, investment value owed to an investors, going concern value, current financial status, liquidation value, amount recovered from sales of asset, book value, accounting measure that in difference between total asset and total liability. Multiple of earning, market price of common stocks and earning per share, discounted cash flow analysis, how much an investor would pay today to have a cash from stream X dollar for the X number of year into the future. Summary: plan financial states carefully, use friendly money first, stick with private placement as long as possible, do your due diligence, get reference, get proactive. Takeaway: that what student took away from the discuss on in real time. So these are the many interesting approach of the uh, financing and other things, and if we can take this financing in a professional way, then we can get more support for our startup. So if you have any kind of question regarding these points, you can communicate with me. Thank you everyone.